Yes. Questions, 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 questions. I'm waiting on for your question. Or no question for now. So we can proceed.
Yes, when we are going, the question can we'll ask.
Yes, sir.
Yes, boss.
Sir.
Yeah, I can hear you.
Yes, sir. I have a question, please.
Yes.
The first question we saw with the activity-based costing.
Yeah.
With the traditional costing, the requirement was that specifically we use the direct labor hours to find the overhead absorption, the basis for the overhead absorption, the total budgeted absorption basis.
Yeah.
In an instance where the question is silent, do we still conform to looking at the variables we have there? Do we still conform to the one that the company uses more?
Yes, that's what I told you during the video, remember? So if
So
you have machine hours, you have labor hours, and you have units, the most appropriate one is the one they use more of. It means that they are more intensive. It means that they are more intensive in that area. Do you understand?
Okay. Okay. So referring to the question, we had direct labor hours, we had machine hours, setup costs, and then others handled in the period. So in the instance where the question is silent for the traditional costing, I'm taking the setup and then the other handled are out. So it's going to be between the direct labor hours and then machine hours. Am I correct?
You are.
Come again, sir.
Yes, you are. Can you hear me?
Oh, okay. Yes, I can hear you now.
I like the way you are getting it. That is how it's supposed to be.
Okay. All right. Thank you, sir.
Okay. Any other question? I think Teddy has asked his first question.
Yes, sir. Please, I have a question.
Yes, please.
In the notes that you shared, calculating the full production cost per unit using the ABC, the steps there is a, what's the name? There is a formula there, which is cost driver rate is equal to total cost in cost pool over total number of cost driver. I want to ask, is the cost driver rate the same as the overhead absorption rate?
Yes. It's the overhead absorption rate for ABC, right? It's the same thing. Just under ABC, we do not calculate one cost. We do not calculate one OAR. We calculate it for each activity. You remember? That's the only difference. Yeah. So it's the same. I told you, even when we're doing it, I told you it's called cost driver rate, but we can still call it OAR, just to be fair, right?
Okay. All right.
All right.
Okay.
Any other question?
Yes, sir.
Yes, boss.
Yes. With the requirement two, the calculation of the activity-based costing.
Yeah.
I realized that we did not tackle the direct labor hours per unit in the activities-based costing.
It's because
and it wasn't.
It was because it wasn't a favorable cost driver rate. Do you understand? It means that yes, they may give you a lot of rates. They may give you a lot of cost drivers, but not all are relevant. Look at machine activity cost. What is the appropriate driver there? It is mostly machine hours. We cannot use labor hours because labor hours doesn't drive machine activity. Unless there was no other basis, then we say, okay, when labor uses machine, it could mean that they use more labor hours to maybe work on the machine, right? So we could take that. But sometimes they may give you a lot of drivers. You have now to think about the one which is most appropriate. That is there, okay?
Yes, sir.
So they'll give you a lot of bases. You choose the one which you think is most appropriate. All right, are we okay? So
Yes, sir.
without further ado, I believe we prayed. Have we prayed?
Yeah, we do.
Okay, so we are going to try the same thing just as a recap. So we have a company here, and what is it asking us to do? It says what? Calculate the total profit on each of Shocker Limited's 3 products using each of the following methods to attribute overheads. So the existing methods based upon direct labor hours and activity-based costing. Okay, so this is the question that we have, right? And the thing that we are going to do is to calculate total profit. And we know total profit means that we are definitely going to take sales or sales price and less what? Our total cost. Do you know that? So now we are preparing a full statement based on these 2 requirements. So we are going to split the screen. Let me just get my Excel sheet. Split the screen so that we can all be fine. Blank workbook. All right. I hope you can see my screen.
Yes, sir.
Okay, so this is what we have. And then they said we should use the existing methods based on direct labor hour, meaning we are going traditional costing, right? So since we are going traditional costing, I told you the most important, say the name of the company was what? Shocker Limited. So we have Shocker Limited, right? So I using what? Traditional costing, right? So traditional costing. So now we using traditional costing. We need to get OAR. So let's read. Who will read for us so that I will save my voice?
I'm reading.
Okay.
Question 2. Shocker Limited produces 3 types of products in the same factory. Product X, Y, and Z. It sells products throughout the West African sub-region. In response to market pressure, Shocker Limited has invested heavily in new production technology in recent years, and as a result, has significantly reduced the size of its workforce. Historically, the company has allocated all overhead costs using direct labor hours, but is now considering introducing activity-based costing. Shocker Limited's accountant has produced the following analysis.
So before you
Product XYZ.
before you continue, we have seen from the preamble that they use direct labor hours, right? Before we have
Yeah.
system. So it means that if we have to calculate our overhead absorption rate using traditional costing or absorption costing, then we are going to use direct labor hours to absorb the overheads. Do you guys get it? Do you guys get it?
Please come.
Is it clear?
Yes, please.
We cannot see this information. Start from
Okay. The 3 cost drivers that generate overheads are deliveries to retailers, the number of deliveries of bread to retail outlets. Setups, the number of times the assembly line process is reset to accommodate a production run of a different type of bread. Purchase orders, the number of purchase orders. The annual cost driver volumes relating to each activity, and for each type of product are as follows. So should I read that one? So the annual overhead cost relating to activity are as follows. Delivery.
you can see all that. So start from
Okay.
all the direct labor.
All direct labor is paid 0.05 Ghana cedis per hour. The company holds no stocks. At a board meeting, there was some concern over the introduction of activity-based costing. Will tell us any more than the use of labor hours in assessing the viability of each product.
So now we are going to compute, right? So first of all, I told you anytime you get such things, the first thing I need you to always get is the OAR, the overhead absorption rate. And since you are using traditional costing, mostly we are going to do a blanket rate because it's a single organization. If there were departments, we'll do departmental rate, just like we did for assembly, finishing, and welding for the other question. Do you remember? So if there are departments, you do OAR for each department. But if it is just one, just like we are seeing here, just one whole organization, we do one OAR. So first of all, we know that this is what our total what estimated or budgeted what overheads, not so total budgeted overhead, our total budgeted what absorption basis, right? And in this question, our absorption basis was what? Labor hours, right? Okay. So the first thing I would do is to determine my total labor hours. So let me get my total labor hours. So what's my total labor hours? Per the question, you see that with this question it was straightforward. They've given me the labor hours in total already. Can you see? True or false? So it makes it easy.
True.
So we just
The total is 50,
so you
50,000.
it out, they will mark it. Okay. So product X, we have 20,000 hours. Product Y, we have 22,000 labor hours, right? Product Z, we have what? 8,000. We put it together, we have 50,000 direct labor what hours, not so, okay. So this one is correctly laid out. So we have direct labor hours, right? But now we need our total overheads, right? So we need our total budgeted overheads. So total budgeted overheads was how much? Okay, we have it here, right? As 2,400 plus 6,000. You can also rearrange it plus what? 3,600. So the total overheads is how much? So it's all up to you as to how you want to do it. Let's add the overheads up. I believe it's 12,000 cedis, right?
Yes, please.
We'll mark this for us. Now, what becomes the OAR based on the direct labor hour? Becomes what? Our total overhead cost, which is 12,000 cedis, over how much? Over 50,000 labor hours. Not so. So that gives
Yes,
us
please.
12,000.
0.24.
That is
0.24.
0.24 per what? Per labor hour, right? What this means is that management accounting is all about interpretation. So if I'm to do a commentary, right? Now, if you do management accounting and you always add commentary, it whets the examiner's appetite. You say that what? For every, are you getting it? For every labor hour, okay, that is used in the organization, also 0.24 of overhead costs, right, is incurred. Does that make sense? So it means that at any point in time that we use one labor hour, we pay, if overhead was a person, we would have paid him 0.24. That's 24 pesos. I hope it makes sense. So the more hours I use, the more I will end up paying overheads. I hope that makes sense. Does that make sense?
Yes, sir.
All right. So now let's go and prepare the profit statement. So traditional costing, right? So this is traditional costing. And we are preparing what? Our profit statement. It says we should get total profit. So that means I need to get an operating statement, right? So in management accounting, when you see operating statement, it's the same as your profit statement because it measures your operating profit, right? This is our operating statement, and I prefer going this way: X, Y, and Z. I prefer working in total, right, instead of per unit. I would prefer working in total, and then I just multiply everything. And then if I want per unit, I divide. So what do we start with? We start with sales, right? So first I need sales. So sales, what was the selling price? Was selling price given? Yes, it was, right? How much was the selling price? You are the ones.
The selling price is 4 for X.
Then we have the quantity produced, right? The annual output for the.
Mm,
We have all of the data, so we just multiply, right? Because you know, selling price will be selling price per unit times the number of units. True or false?
mm,
Okay. So we know that for X, we sell one for 4 cedis, but we are producing what 2,000 units. Not so. All right.
mhm.
That gives us what for X? 4 2
8,000.
plus 8,000 cedis. Okay. Now we come to Y. Y gives us what? 6
9,600.
selling 1,006. We get 9,600. Not so. Z
Yes, please.
8.
3,200.
That's 3,200, right? Okay. So selling price, we are done. I cross it off. So I can call this A, right, as my selling price. Now I need cost, right? So that means that I need to get my costs. Okay, so I can call my cost B. So what cost did we have? I believe when we come here, we see what? Material.
Material.
Somewhere down there, they told us direct labor is paid what? 0.05 per hour. It means that there's also labor cost, true or false? So you see how they went to.
Mm.
But so far as we see material, there will be labor and overhead. So now we have all the data, right? So now let's go to what? Direct what? Material, right? Now in exam, I don't want you to write, you know, I prefer you do all this up to prime cost, right? Before you add the overhead, so that if you are doing the traditional one, you can pick the prime cost. If you are doing the ABC, you just go and pick the prime cost there instead of building the whole thing again, you see, which can waste time because these figures will just be the same except the overhead part. Do you understand? I hope it makes sense. Or it's not clear. I'm trying
Yes, sir.
if you build from here to prime cost, even if you are doing ABC, that calculation will still be the same because the only difference is the overheads. Do you get it now? So direct material, let's take X. X direct material per unit was what 40 pesos, not so. But how many units were we producing? 2,000, not so. Okay. Then Y was 60 pesos. We're producing 1,006. Z was what? 90 pesos. We're producing what? 400 units. Okay, so direct material will give us how much?
$800.
100 cedis. That's 960. That's 360. No, okay. Then we need direct labor. Not so. Okay. Direct labor too, we need the total, not the per unit. You can get the per unit, the hours per unit, right? But here lies the case. They said direct labor across all the products, they are paid the same, right? How much are they paid?
Mhm.
Says they are paid 0.05. Do you remember? Now
Fine. Yes, please.
use this 0.05 and multiply this by the total number of labor hours. Not so per hour. So 20,000 labor hours. This one, 22,000 labor hours. And this guy, 8,000 labor hours. So I believe you all know where I'm picking the figures from.
Yes, sir.
So multiply this by the 20,000. That means this guy will get paid 1,000, right?
Yes, sir.
1,100. And then
400.
now, were there any direct expenses? Not that we know of, right? They didn't mention anything apart from the overhead. It means that the sum of this is the prime cost, right?
Cause.
The sum of all direct costs. So the only direct cost we had is this. So when we put this together, we can easily get our prime cost, which is 1,008 for this guy. This one will be what? Is it 2,160? Or
Yes, please. 2060.
then this one will be 760, right? All right.
Yes, please.
Prime cost. Now we add our production what?
Over.
Overhead. Now the overheads, we have already gone to work for the overhead absorption rate, right? So this is literally the OAR times the labor hours, because the OAR was measured in labor hours, right? So in that case, when we come to production overhead, when we take X, here all of them were measured in labor hours. So we have 0.24 per hour. Do you remember? So 0.2.
Mhm.
How many labor hours were used?
Mhm.
Use 20,000 labor hours, right? When we come to Y, is what? 0.24. How many overhead labor hours were used? 22,000 or so. When it comes to that, still 0.24. How many labor hours were used? 8,000 or so. So we now multiply. So you take overhead as if it's a person working to get paid, right? Now we pay him.
Mhm.
So if he works for 20,000 hours, he'll end up incurring a cost of 4,800. No, so we come to this guy, 0.24, but he's working for 22,000 hours. That is 5,280. $1,920. Not so. So I believe this one, once we are done, that gives us the total cost for each of these ones. So now we have our total cost. So that's our prime cost plus our overhead, right? So we have 1,800 plus 4,800. That gives us 6,600. 2060 plus 5,280. That gives us 7,340. We have 760 plus 1,920. That gives us 2,680. Now, so now we can easily get our profit, right? We know that cost is B.
Yes.
Our profit becomes what? A minus B, not so, which is sales up here minus our cost.
Yes.
Henrietta, your hand is up.
Yes, please. I'm a bit lost. Please, how did you get the 0 point for the production overhead? The 0.24. Please, how did you get it?
R O A R O A R. Are you okay now?
Okay, okay, alright. Yeah, I'm okay. Thank you.
No. Please, is everybody on point now? So let's get the sales. So sales becomes what? 8,000 minus 66. What do we get? That's 1,400. Not so. Okay. And then the other minus 7,340. 96 minus. That's 2,260, right? 2,260. And then the next one,
520.
So it means that this is our statement based on traditional costing, right? Using traditional costing information. I believe traditional costing, this revision was not bad, right? Okay. Now we are going to use ABC. Just change the color. Let's use orange or pink. Okay. So using ABC, remember ABC is based on activity, and then you look at the number of activities and you do OAR for all of them. So under ABC, the OAR is now what? The total cost in the cost pool all over the total number of cost drivers, right? Total number in the cost pool over the total number of cost drivers. So in that case, how many activities did we have?
3.
3. So we pick them one by one and do OAR for them. So the first OAR is OAR for deliveries to retailers, right? So what does OAR become? It becomes what? The total delivery cost, right?
Yes.
All over what? What becomes the appropriate driver? Delivery to retailers. The number of delivery. I get it.
Of battery.
So we use that as the driver. So that's over the total number of deliveries, right?
Yes.
Okay. So that is it. So in that case, what was our total number of deliveries? Total deliveries that was done.
100,
100 plus what? 80 plus 70.
80 plus 70.
Does that gives us 250 deliveries?
Yes, please.
So we have our 250 deliveries. So in that case, our OAR for delivery gives us what?
350.
That's our total cost of delivery was 2,400, right? Divided by 250 deliveries.
50.
And that gives us what? Per delivery, 250. That is 9 CD, 60 pesos.
9.6.
Right? So for every delivery made within the organization, it costs the organization 9 CD, 60 pesos in overheads. Does that make sense? Okay, so now I've been giving you the commentary. The next commentary, you guys have to provide it for me. I said for every
Okay.
retailers, it costs the organization what? 9 CD, 60 pesos in overheads per delivery. Do you understand? Okay. So now what's the next one? The next activity is what?
Setup cost.
Setup cost. Okay, so when it comes to setup cost, the OAR becomes what? Somebody should give me total
The total setup cost.
setup costs over the total number of what?
Number of times the assembly line process is reset.
So total number of setups, right?
Mm.
Number of set. So in that case, let's get the total setups.
35 plus 40 plus 25.
40 plus 25.
100.
100 setups, right? Okay.
Yes, please.
That means OER for setup will be what?
It will be 6,000 divided by 100.
100 setups, right? Okay.
60.
60 per setup. Okay. So somebody should interpret this for me. For every
For every setup, it costs the
Setup.
organization 60 per, 60
60
cedis per setup.
because the organization 60 CDs in overhead.
this overhead.
Overhead. Thank you. What's the last one? Purchase orders, right?
Well, then, yes, please.
Purchase orders. OER. So that gives us what? Total purchase
800
orders
others.
over total number
Number
of
of purchase orders.
So in that case, what's the total number of orders?
It's 800.
600.
Plus 300 plus 100, right? Giving us 800.
800.
So in that case, what becomes the OER? You see the difference between this one and traditional costing. The traditional costing, add everything up and use one particular basis. But with this one, each activity has its own OAR. You get the difference. So in that case, our OAR for purchase order becomes what?
2,600 divided by 800.
$3,006 over 800, right? For this, which
4.5.
costs the 50 pesos per order.
Mhm.
So interpretation for every
For every purchase order, it costs the organization 4.5 cedis in overhead.
that is it. Okay, so now we need the operating statement, right? ABC
Yes.
statement. So now to get the operating statement, it will become easier for us because we already have the data, right? So I just take X, I just take Y, and I just take Z. Then I say from A above, right? Do you get it? Because I already have this information from A. So that I refer the examiner. They'll mark it for you. Because in exam, you'll not have the luxury of time to be doing this long. So I can pick the sales as done above, right? Do you get it? So we just go and pick. I hope you are learning the exam technique. But another student will go and build the whole thing again, which can waste time. Because multiplying. So I pick 8,9632, right? So I come down here. I pick my 8,000, pick my 96, pick my 32, because this doesn't get affected. It's only the overheads. Does that make sense? Then I come to cost.
Mm-hmm.
Cost. I already have the prime cost. Do you remember? So
Mm-hmm.
I pick the prime cost. I've already worked for it from above. I'm just going to pick the prime cost. What was the prime cost? It was what? 1,8, 20, 60, and 760, right? So 8, 20, 60, also, and then 760. Okay. Then now I say production what?
Mm-hmm.
Overheads, right? Okay. Nicely said. Now overheads, I'll break them down, unlike traditional costing. So the first overhead was what? Delivery cost, right? So cost, you underline it nicely. So under, though you can do this separately and bring it here, I prefer to do it on the statement. Anyway, me, I don't have one method. Any method goes with me. So we go to delivery cost, then we go and check. Delivery cost was what? 960, right? 9.6 per delivery. So that's the rate. X will take what? 9 CD, 60 pesos per delivery,
Yes.
times how many deliveries were done. Then you come back to the question. Number of deliveries. 100 for this,
100.
70 for this, right? So we just multiply
Yes, ma'am.
that we did, right? So this one will be by 100 deliveries. Y will be the same 9.6, but by how many deliveries? 8
80.
deliveries. Then Z will be what? 9.6 by what? 70 deliveries, right? All right. So now we multiply 9.6 by 100. That's 960 for this guy. 9.6 by 80. That's 768 for this guy. Then 9.6 by 70. That's 670 for this guy. All right. Now we are done with delivery. The next one we have to do is for what? Setup cost. Come to setup costs. So setup cost, nicely set. We come and then we take X. Setup, what was it? It was 60 CDs per setup. Do you guys remember?
Yeah.
Multiply by the number of setups. This one took 35 setups. Why 60 CDs per setup? This guy took how many setups? 40.
40.
Guy 60
Okay.
setup. This guy took how many setups? 70. No, 25, right?
25.
We multiply again 60 by 35.
200.
100. We have 60 by 40. That gives us
400.
60 by 25. That gives us 1,500, right?
100.
So that is done. Then the last one that we have, the last overhead, which was purchase
The
or
purchase orders.
purchase orders. So when it comes to purchase orders, let's see. What did we get? I think, was it 4.5 or 4.5?
4.5. 4.5.
So I come here and say X, 4.5 per order, right? Now, how many orders down for this guy? 400 orders.
400.
By
When we say
order. But we made what? 300 orders. Then we have 4.5 per order. But we ended up with what? 100 orders.
100.
So 4.5 by 400.
180.
4.5 by 300. This guy gets
1350.
4.5
1350.
gives us
450.
I believe we can get our total cost, right?
Okay.
Which we can call B. Because we already have A as the sales, right? Okay. So in that case, let's add our cost from prime cost down to overhead. So I think this one we have 1,800 plus 960 plus 2,100 plus 1,800. That gives us 6,660, right? 6,660. Okay, then I have this one. That is 2060 plus 768 plus 2,400 plus 1,350. That's 6,578. 6,578. Then I come here to 760 plus 672 plus 1,500 plus 450. That's 3,382. All right. So now that we have that, we can get our total profit. Okay. Total profit as A, which is sales minus the B. So we can pick our sales from the top, 8,000 minus 6,660. 8,000. 8,000 minus 6,660. And that is 1,340. Then we come here, the sales was 96, right? So we pick 96 against 6,578. So you have 3,022.
P3.
96 against 6,578. 3,022. Then I have 32 against 3,382. So 182 loss, right? Okay. So sometimes the examiner will ask you, which one is the better assessment of profit? Is it a traditional one or is ABC? Which one gives you a more accurate profit per unit?
ABC.
ABC, because it is now having accurate information about what drives the cost. I get, and it is used in modern manufacturing environment. So it provides what? If they ask you, why does ABC show a more accurate representation of the profit? They are asking you for the advantages of ABC. Do you understand? Or the disadvantages of traditional costing as compared to ABC. Okay, so that brings us to the end of ABC. I hope this was good revision. What we did on Sunday, this is revision for it. Okay, so I hope those who missed the session, you can ask me questions before we move to the models of evaluation. And the first model of evaluation we'll be looking at will be the theory of constraints, throughput accounting, right? But before we understand throughput, still in costing, I must teach you marginal and absorption costing. We already know absorption costing, but we have to know how to prepare statements from the perspective of marginal costing and absorption costing. Because the examiner has particular ways he's going to ask us questions, and I will show you why these things are important, right? Please, I'm waiting for your questions. Yes, I'm waiting for your questions, please. I don't like the silence. So as I'm here, let's just walk through the examiner's tips he's giving you for this diet and any diet in this syllabus. Okay, let me ask you if you know this. If you know, you just give me a yes. If you don't, you say no. Introduction to management accounting. Make sure that you can explain the different information needs of management at different levels of the organization. Can you do this? Can you do this?
Yes, sir.
Okay. You need to know the 5 fundamental principles that are foundational for the IFAC Code of Ethics and the different types of threats to these principles. This may feature as part of every question or some questions on
Please.
yes or no. We've done that, right?
Yes, please. Yes, please.
2, you should be able to explain the shortcomings of traditional costing when a company has high overheads and low direct labor cost. Can we do this? the disadvantages of traditional costing against ABC. Can you do this?
Mhm.
Yes, I taught you. We looked at the disadvantages of traditional costing, right? It uses an arbitrary basis to allocate overhead. And now we are in modern manufacturing environment. In the past, overhead used to be a small proportion of total cost. Not so. And this one uses just one basis, which is not realistic. You get it? Because some other things may be influencing other costs. We saw that, didn't we?
Yes, please.
You must be able to apply ABC. Can we do that?
Yes, please.
This involves linking cost to activities and using this as a basis for transferring cost to units of production. We just did that today. Study the examples carefully, come back to them later and try to work through them, covering out the answer first. We've done all this. You may also be asked to list the advantages and disadvantages of ABC. He goes for it to add something to it. He says what? What does he say? What does the examiner say?
Learn these.
Learn these. It means that when you don't learn, it can take you by surprise. I told you we are passing first attempt. So anything I say, just take it to heart. Is that clear? Does that make sense? Okay. Anything I've said, take it very serious. Though. These things are all questions. I'm telling you, you may be shocked. Now we come to models of evaluation, and this is where I'm concerned about. Now listen, it says what? A question might ask you to prepare a performance statement based on what? Absorption costing, marginal costing, and throughput what? Costing. It means that yes, most people will just be teaching you only throughput accounting because they will assume, oh, marginal and absorption costing, you did it in the previous level, right? Yes, we are not supposed to teach you, but I will take the time to still teach you because I assume that you haven't done costing before, right? I am teaching you costing. So we'll take the time, understand absorption costing, marginal costing, and then we now go through what throughput accounting, because once you understand marginal costing, throughput accounting will become easier for you. And the same technique will be used to do what we call limiting factor decisions. Are you getting it? All right. So make sure that you understand the difference between the three methods, and we'll look at the differences between the three methods in terms of stock valuations. Okay, so the differences are all to do with whether an amount is written off in the period, or is capitalized as part of inventory value, right? That's fixed cost is what they are talking about. So actually, the difference between these methods is either we have period costs, okay, a cost that is written off as an expense in a period, or a product cost, a cost that forms part of what? The product production cost. So product costs are just production costs. So does it form part of production cost, or it form parts of what? Non-production costs, which are period costs. Okay, meaning we do not absorb. Anytime you see period cost, it means no absorption, right? So it means that all fixed costs are treated like the way we have expenses, right? We just write them up. So no absorption. And mostly the only one where there's no absorption is mostly marginal costing, right? Marginal costing, no absorption. Marginal costing's mirror image is the modern one, which we call throughput accounting, right? Or throughput costing. So we are going to learn all these, right? Now, throughput accounting also relates to performance, to the theory of constraints and bottlenecks, right? And we'll come and look at a key performance ratio. And even the theory of constraints, we'll understand when there's shortage of production, maybe shortage of machine hours, shortage of labor hours. I'll give you a quick trick which you can use, because throughput accounting will come this date, okay? ABC will always be there. Throughput will come this date. I've told you, so take it to heart, right? So the throughput accounting ratio, TPAR, it's a very important ratio, okay? And I'll teach you various ways we can use the TPAR to assess product profitability. Now, be prepared to calculate and interpret this ratio, you see, examiner telling you, and suggest how it can be improved. So if the throughput accounting ratio is greater than 1, we say the product is profitable, right? If it is less than 1, we say the product is what? Loss-making. Does it make sense? So, okay, assuming this one was less than 1, how can you improve it? Assuming it was even greater than 1, but the highest product had, let's say, 1.56, not so. Let's say your competitor's product had this after giving you information, and you also had 1.02. How can you improve this to bypass the competitor? It's still performance appraisal, right? So you must have some methodologies to try and what? Control how profitable this product may be. And being profitable, you know, profit is what? Sales minus what? Cost, right? So how would we increase profit? By reducing costs or increasing sales, right? So you can dive into the components of cost and see which one you can control, like inventory cost. Can we negotiate better prices with our procurement, our suppliers? Can we talk to HR to look for what? Quality but low labor rates? Do you see how I'm trying to look at this? So some of these things, they are practical. It means that you must focus on cost reduction and cost control. Do you understand? And that's why, as a student, all these methods are required for you to look at them, right? Okay. So improvement can be made by increasing throughput, increasing sales price, reducing the material cost, or reducing the time on bottleneck resource, or reducing operating expenses. So this is the first part of the models of evaluation. Now, a question may also be said asking you to recommend an optimum production mix. And this is a full question which will normally come between 15 to 20 marks, right? It can come even as 10 marks. Your duty as a student is to be able to do this. Given a bottleneck constraint, the problem can be solved using an approach similar to limiting factor analysis or key factor analysis, but using throughput per unit of limiting factor rather than contribution. I'll teach you this. Now, from there, what we are supposed to look at.
Come on.
From there, what we are supposed to look at is environmental management accounting. Here is basically pure theory, but there are some things that maybe I'll introduce to you, like target costing and environmental, I say environmental, life cycle costing, right? I'll just do some few examples just to give you a preliminary, because it's not directly in your syllabus, but it's hidden under this particular topic, right? So make sure you can explain the purpose of environmental management accounting and environmental costing. And the remaining topics are not difficult to understand. The examiner has told you. And it should feature in discursive questions, meaning they'll mostly come as theory. Okay, things like just in time, things like benchmarking, value chain, re-engineering, right? So more information on benchmarking, we'll do it when we get to performance and ratios, right? KPIs, okay? And now ratios will feature every data as part of your paper. Whether you like it or not, it may be hidden somewhere, but you should be ready to prepare, whether it comes from the portion of public sector ratios or it comes from the perspective of, what do we call it, divisional performance or normal appraisal, where you'll be calculating ROC and other ratios, profitability, liquidity, gearing, investment. But mostly management accounting is internal performance. So hardly do you see investment ratios. If you see any investment ratio, the only one you see is mostly earnings per share, okay, or dividend cover, just to maybe appease investors. Okay. Then from there, the next thing is to talk about quality and the impact of IT. The quality was in your syllabus, but IT is a new introduction, right? This wasn't in your syllabus before. IT was there, all right, but IT was under information systems only. But now we are going to look at real-time processing of data information, the use of increasingly sophisticated software like machine learning, AI, and a gradual move by organizations to cloud computing. So things like big data, cloud computing, we need to know the advantages and disadvantages of them and the ability to comment on them, right? Then quality, we understand total quality management, the types of quality costs. So we have conformance and non-conformance costs that we have to look at, right? Conformance cost includes costs to conform with quality. We have appraisal and prevention costs. Then we come and look at non-conformance costs, meaning you didn't conform to quality and you are facing the consequences. Internal failure costs and external failure costs. We'll learn how to even calculate full questions on them. And this provides the foundation to understanding continuous improvement and TQM. Then we understand the processes in TQM. Then we must be able to describe those techniques that we have seen above, right? So after we are done with this, the next thing will be budgets and budgetary control, which is another thing for next week. But this week, our focus is just on these areas that we are seeing, the models of it. Questions are going to come from this area. Models of evaluation, quality, and the impact of IT, right? So budgets are for next week. Is that okay? All right. So this week, this is our focus. So with that being said, if you have any question, you can hook me up. If not, we can proceed. Yes, boss.
Hello.
Hello.
Yes, sir, please. You said the book, when is it going to make ready? So that the theoretical aspect. Huh?
Please exercise patience for me. I'm working on it. Remember, I'm the only one working on more than, I can't even fathom the number of books I'm working on. So I'm still on it. So once they are ready, I'll
Okay.
go ahead. Okay. For now,
Because maybe
I'm currently
okay.
principles of taxation and advanced tax. I will finish this weekend. Then I can look at you. You know, corporate reporting people too are on my neck. FR, they are on my neck. Charlie, it's not easy.
Okay.
I will just.
But so by hopefully next week.
Hey, Chairman Abucheo, next week. You just exercise
Because
notes. That's what I've said.
we need it.
No, that's
We
what
also need the reading materials.
that's why I've sent you notes. Where I believe you need notes, I send them to you. Okay. Just
Okay.
start to wait for the books.
Okay.
So you see, I sent you a note on performance and evaluation. Just focus there, read, digest it, understand where there's a need for
All right.
till the book is ready. And I don't also want to rush to make it you understand what I mean. Yeah. So
All right. So grateful.
you're welcome, sir. Always at your service. All right. So just-in-time system. I believe I sent you a video on just-in-time, but let's just look at just-in-time inventory system again. Now, when we talk about just-in-time or JIT, it is actually a business and production strategy that seeks to eliminate excess stock of products or raw materials producing reactively to customer demands and not before. What it means is that we keep no stock. So just in time is simply no stock. It was invented in Japan and people have adopted it ever since. And this was actually to meet the process of continuous improvement or what we call Kaizen, right? Now, if I keep no stock, I just produce just in time for consumption, or I just buy raw materials just in time for production. Do you get the idea? So this is me, the company. I know that I need 5,000 units of material X, right? And I know that I always use material X. Now, if this is my supplier, do you get it? My supplier will always provide me this 5,000 units to produce, such that I do not have any excess stored down for production next time. That means this guy must always be reliable. Do you guys get it? He must always be reliable and he must always come in time. And when we finish producing too, we do not keep stock. So if we have 10 customers, whatever we produce should serve the 10 customers. Nothing more, nothing less. We can't keep stock. That's how just-in-time works. But that means that our production system should also work well to supply these people, true or false. And then our suppliers must be reliable and give us goods that will also meet production. So it means that we have two types of just-in-time systems: just-in-time purchasing, where we buy from the supplier, and just-in-time production, where we produce and then deliver just in time for consumption to the customer. Somebody said, can you send a just-in-time video? Go to the YouTube channel. I mean, even on the Man Accounting page, you can even re-forward again. Okay, so shall we proceed? Now, this is generally known as stockless production, as nothing is wasted in production. So just in time, we don't make room for wastage. We don't make room for storing of stock, right? So in short, just-in-time inventory system focuses, are you getting it, in having the right material at the right time, at the right place, and in the exact moment. I like this, right? The right material at the right time, at the right place, and the exact amount or in exact quantities. So just in time is not just for materials entering the production process, but also for the end product as well. So the aim is to produce the product just as it is required by the customer, so that stocks of finished goods are kept to a minimum. Now, this requires producing to customer order or accurate forecasting of customer what? Demand. Does that make sense? I explained this before, right? So I told you there are what? Two types of the just-in-time systems. What are the two types I mentioned? What are the two types of just-in-time systems?
in time purchasing and then just in time production.
Yes. So those are the two that I mentioned. Now, the just-in-time purchasing relates to the purchasing of materials at the right time, at the right place, and in the exact moment needed for production. So a simple example of this would be a car manufacturer that only orders its steel once it knows exactly how much it will need in that particular production period, thus eliminating waste, as the company should be, in theory, be left with no excess materials, right? So a company without inventory does not want a supply system problem that creates a parts shortage. As a result, the supplier relationships become extremely important and thus are worked upon by both parties. This can have advantages in terms of delivery times. The supplier may set up a warehouse near to the company's production facility, for instance, cost and quality. Now, what most companies do is that they do what we call forward integration. They try to acquire such suppliers, or backward integration, right? Where they try to acquire the supplier, or forward integration, where they acquire the customer so that they can have definite measures of whether the finished goods or raw materials they're buying. So often, companies using just-in-time systems work with their suppliers so that regular small deliveries are made, avoiding even the smallest level of inventory to be held. Because I believe, let's say, if I need a marker, right? I need marker to teach, and I have good relationship with my supplier. They can even bring me one marker and they won't stress. Do you understand? But assuming I don't have relationship with him and I tell him to bring only one marker, do you think he will do it? No, he wouldn't. So supplier relationships become very crucial in a just-in-time system. Are we okay? So for example, in our still example I gave, deliveries could end up being made a few times a week or even a few times a day if necessary, so that it is delivered as is needed for production. Okay, so that was just-in-time purchasing. I hope you understood. If you have any question, you can ask me, right? All right. Now, just-in-time production is when we produce just in time for the customer, right? So just in time is not just for materials or raw materials entering the production process, but also for the end product as well. So the aim is to produce the product just as it is required by the customer, so that stocks of finished goods are kept to what? A minimum. This requires producing to customer order or accurate forecasting of customer what? Demand. So we have seen the two types. Now, this is where IC will mostly ask you questions. I told you when you are learning every model, you must learn what? The advantages and disadvantages as well. So this one, you don't even need to read any book. This is where I want you to interact. Now, I want people to answer me. Assuming you don't keep any stock in your business, what are the advantages you are going to enjoy? Forget about what we just read. What are you going to enjoy if you don't keep stock? Let me give you the first one. One, I will save storage.
Okay. Storage space.
You will save storage costs, you save space. What else? There are a lot of them.
You will not be taking stock. We save time.
Okay, it saves time. What else?
Mm.
Only one.
You not keep obsolete goods.
Okay. Some stock may get spoiled. You will not have that case.
Yeah.
I like that.
Yeah.
Yes, any other? It's the same person. It's only Alberta. Yes, I want the rest to also talk.
You will not have to pay for security for their goods.
Okay, you will not have to pay for security for the goods. Yes, any other? Okay, somebody said no pilfering. Yes.
Sir,
Let's go. I can hear you.
yeah, I think there'll be no wastages
Okay, there will be no waste.
once you don't have inventory.
I'll take it. Yes, any other? Any other?
Sir,
Yes, please.
you will not have closing stock, which will translate into opening stock for the following year, thereby reducing the cost of sales.
I like that. Accounting, eh? Nice. Okay. I mean, these are good points. They are all correct, right? Now let's look at the disadvantage of not keeping stock. You don't need to read any book to do this. Disadvantage of not keeping stocks. If you don't keep
You may miss out on an order.
Order, yeah.
order, that is
As in emergency orders.
Emergency or shortage. We would always run into shortages.
sure. Is that all?
You always there's a possibility of you buying at higher prices since you are in need of the stock for production.
Okay.
And
Sometimes
you also
miss
that
out on
stock
bulk.
overstock.
Sometimes you miss out on bulk discounts, right?
Yes, sir.
And then sometimes some goods need to be stored to mature. You cannot you cannot deal in those kind of goods because you don't keep stock, right? You may miss out on price speculations because sometimes you buy goods in bulk so that if prices go up, you can still keep them. You miss out on all those, right? So these things, you don't need to read them. That's what I'm trying to put across. Not that we are giving points, but some things are there. Assuming they come to exam, then somebody will be like, oh, said this thing, you didn't teach us. This thing, are you supposed to be taught? There are some things that you are not supposed to be taught. You not keeping stock is something that you can think and write. Does that make sense? All right. So, as I said, before we look at throughput accounting, we must understand marginal and absorption costing. I said before we look at throughput accounting, we must understand what?
Marginal
and
and
absorption cost.
absorption costing.
I believe when we understand marginal and absorption costing, it will make it easier for us to understand everything that there is to understand and even understand throughput accounting very well. Okay, so operating statement in management account. And you know, this thing is very key, especially when you come to budgeting, variance analysis. Very, very important. Because every time you are doing variance analysis, they are going to ask you, okay, they are going to ask you to prepare statements, and it could be based on marginal costing or absorption costing. And it depends on the system the company runs, right? So a lot of students mess up because they don't pay attention. So I want you to have this in your head. Under marginal costing, we don't absorb. Please repeat after me. Under marginal costing, we don't what?
Absorb.
We don't
Absorb.
have this in mind. So before we even look at marginal and absorption costing, let me take the time to take you to our good friend, cost behavior. My lecturer will say cost behavior, Mbasubang. See how you say. How is cost behavior related to Mbasubang? So cost behavior. Does women and cost have relationship? All right. So marginal cost.
Yeah, it's true.
So marginal costing starts by understanding cost behavior. Cost behavior is another classification of cost, right? On how different kinds of cost behave. So we learn different classifications of cost by nature or element, by traceability or linkage. Then we learn by function, right? Okay. Now, at every topic we do, there's a particular way of classifying costs. Either we use the one we know already or something new, okay? So when it comes to cost behavior, there are different classifications of cost, right? I believe most of you have heard them before, you know them already, but there are two. That two can be subdivided into other ones, or they can be combined, they can be changed. So we have what we call variable cost, and variable costs play a key role in management accountants. So this is the focus of your paper. If you understand variable costs well, I believe you wouldn't have a problem, because we'll come and look at some concepts there. Then we have fixed costs, okay? So you must understand the nature of fixed costs. They are easy to understand, right? Then we come and look at step cost, right? Step costs, or what we call stepped fixed costs. Then we look at mixed cost, or what we call semi-variable cost. The semi-variable cost. Now, semi-variable cost is what they use to fool students in the exam. Where will you need it? Budgets, where you have to prepare the budget cost allowance. Where will you need it? Variances. Where will you need it? Costing. Where will you need it? Making. Okay. So at your level, we don't learn topics in isolation. These things, semi-variable costs, are literally used everywhere, almost in every topic. I even forgot it. Performance, right? But this one, because it's a combination of fixed and variable costs, right? We say whatever God puts together, no man puts us under. But this one, nobody God put them together. So semi-variable cost is a cost that has variable elements and fixed elements, right? So we split it. Anytime things are together, we learn how to split it as accountants. That's our job. One day we'll answer God. So semi-variable costs, we split them into their fixed and variable components, right? And that is where in your syllabus, there's something we call the high-low analysis, right? Do you understand? Now, when you understand these techniques, then I believe that, oh, my students are fine. There's no question in this earth around these things, budget, variance, costing, right? Decision-making and performance that will beat you if you are good with costs, right? Okay. Now, most of the time, variable costs are everywhere because variable costs, most of the time, we control that cost. For instance, if I go to Shell and I don't buy petrol, I don't incur any cost for petrol. True or false?
True.
Right? So there are variable costs are costs that change as level of activity changes. Okay. So we talk about variable costs first. Now, variable costs are very important in your job as a management accountant. So variable costs, we are going to look at variable cost in total, right? And variable cost per unit. Okay, very important. Now, let's understand this. In total, variable costs vary with the level of production, right? Or your level of activity. So if here is a unit produced or the level of activity is the number of units or your cost unit, right? Let me put it that way. Okay, and here is what? The money, Ghana cedi. So we are saying that, okay, if I go and buy 1 liter of petrol, right? If I go and buy 1 liter of petrol, the price for 1 liter, okay, how much is 1 liter of petrol? Ouch. How much is it?
15.25.
Okay,
14.99.
Okay, so let's just make it 15 cedis, right? So now if a liter is 15 cedis, if I buy 2 liters, right? If I buy 2 liters, which is 30, right? You see, if I buy 3 liters, which is 45, you see something happening. If I buy nothing, what happens? 0, right? If I buy 1, they meet here. If I buy 2, they meet here. If I buy 3, they meet here. If I buy 4, they meet here. So what do you see? You see this, right? Can you see? So that tells you that what? For variable cost in total, if level of production increases, the variable cost also increase. But it's not always so. It could be that when one increases, one decreases. But so far as one changes, the other must change. Do you understand? So I'm telling you this, have it here, that variable cost change with level of activity. So the more the level of activity, the more the cost. I hope that makes sense. I used a better example for you. Did you understand? The more you buy, the more cost you incur. True or false? True or false?
True.
True.
Now, whether you buy 1,000 gallons of petrol, 2 gallons of petrol, 100 gallons of petrol, the price or the cost of 1 gallon will remain the same. True or false? No matter the gallons you buy. True or false?
True.
One thing I want you to understand, that variable cost per unit is always constant. What did I say? Write it in capital letters. This is the main reason why people fail management accounting, especially decision making and budgeting. I want you to have it in your mind. I said variable cost per unit is always what?
Constant.
Okay. That I'm giving you this technique because most questions will tell you that a company has this information, okay? It has information for July, which is, let's say they produce 100,000 units, okay? They produce 100,000 units. Information for December, right? Where they produce 200,000 units, okay? And then the cost for July was 400,000 cedis. What will be the cost for December? We don't know. But if you know this principle, then this becomes very easy. Do you understand why this becomes very easy? Because you know that the cost for one unit will always be the same, right? So far as it's the same, why not find the cost for the one and use it to multiply the 200? I will get this figure. Do you get it? This is why people are failing management accounting. I won't lie to you. Management accounting is not difficult. But if you don't understand the principles, I see a student focus on questions. It is never question. I can give you 3 management accounting questions on the same topic. All of them are different. You need the concept. If the concept is clear, you would not have a problem. Does that make sense? So basically, because I know this is constant, then I know I can easily find it, right? So I can get my variable cost per unit, which becomes what? My total variable cost of what? 400,000, which was available for how many units? 100,000 units. Meboa. Because I know this is constant across all levels, irrespective of the level of activity, I know this will be 4 cedis per what? Per unit. That means for every unit produced, variable cost is 4 cedis. So if every unit produced, I incur 4 cedis for every unit. It means that even if I prepare or I produce 50,000 units, variable cost will still be 4 cedis, meboa. So since it is constant, then if I want to get this, what does it become? It means variable cost for December become a total variable cost for December of the what? A variable cost per unit times the number of units. Meboa.
Yes, please.
It means that 4 cedis by the 200,000 will give us the cost for what? December, which means December should be what? 800,000 Ghana cedis. Do you get it? And this trick is hidden in almost every question that involves decision making. Let's try and let's see something. For me, I like challenges. So I just want to prove to you, we are going to look at a special order decision in management accounting. Be like, oh, so this is how the thing is. Yes, this is how it is. It's not difficult. You just need the right information and you should be fine. Okay, so let's see something here. Looking for a special order decision. Why did I open make for buy? Come on. Okay. So look here. Let's see. Zombie Limited. All right. So look, Zombie Limited manufactures a market slimming product, slimming and body shaping drink, which they sell for 20 pence per can. So let's make it 20 pesos, right? Currently, output is what? How many are they producing currently? That's about 400.
400,000.
So this is now, as a now. Now, this is one thing you must understand. Anytime you go to exam and they tell you that somebody is operating at 70% capacity, okay, it means that they are not using their full capacity. There's a spare capacity because remember, everything should be 100%, right? So if they are using 70, make sure you find 100. And you can use ratio to get it. That if 70 is equal to this, then 100 will be what? It will be more, right? So if more, let's divide. Or simply, you can take whatever you have, assuming you get a percentage in 100, right? For instance, remember, they are saying that if 400,000 cans represent 80% of their installed capacity, okay, then what will 100 be? So you can say if 80% is equal to what? 400,000 cans, then 100 will be what? It will be more, right? So if more, let's divide. So you end up with 100 over 80 times what? 400,000. I'll teach you a trick right now, which will make it fast. Instead of doing this long thing, remember that this one can be rewritten as 400,000 times what? 100 over 80. True or false? And we know that anytime you are multiplying something, it's the same as dividing by the reciprocal. True or false? So this is the same as 400,000 divided by 80 over 100. True or false? And this can be rewritten as 400,000 over 0.8. So anytime they ask you that this guy is operating at 70%, get 100%. If I know this 70% is 400,000, I can just say 400,000 divided by 0.7. I end up with 100% straight. Instead of going 100 over 80 times 400,000, I can use this short approach, right? Then I get it straightforward. Management accounting has a lot of techniques, and I'll teach you all those techniques, okay? And also be looking at the two sides of a coin. If they say variable cost is 60%, then it means that profit to be 40%. Do you understand? Of sales. Get it? Anytime something is one side, then the other side is something. Do you understand? These rules, when you have it, it makes everything easier. Before, if you are doing management accounting in ICA, you will learn algebra. You learn algebra all over again. You learn mathematics. You learn cost, profit, equation. You learn data analysis again, because those things are important. Management accounting is just math in somebody's perspective. It's still mathematics. So don't forget. So if I tell you a company retains 60% of profit, it means how much does it pay out? It means it pays 40%, right? So if you have this, instead of going the long way, you know that the other side of the coin is this. Do you understand? I hope you have learned something. So anytime they give you a percentage, like you are operating at 90% capacity, and that one you produce 500,000 bottles. So what becomes 100% capacity? If you are finding the 100% capacity, it becomes what?
500,000 divided by 0.9.
By 0.9. Then straightforward, you are gone, right? Instead of going the 100 over 80 times this, you just take the 500,000 over the 0.9. This only works when you have something already and you want to get 100%. But assuming they said this one, you need 70% of it, right? You need 70%. That means you must do this, get 100% before you now multiply by 70. Do you get it? Or simply you can multiply by 0.7 over 0.9, right? That means you are dividing by that and you are multiplying by this. Makes sense? I hope we will not forget this. All right. So, just as we said, variable cost per unit are constant. Now, they are telling you that 400,000 cans represent 80%. Okay. Now, they have an opportunity to utilize their surplus capacity, which is the excess of what? If you are producing 80 and then you have surplus capacity, it means the surplus capacity is what? What percentage?
20%.
20%. So if 80 gave us 400, the 20% will be what? You can easily find 100 and find the difference, or just find 20%, right? You get the idea. So by selling their product at 13 pesos per can to a supermarket chain who will sell it as their own branded label product, total cost for the period was 56, out of which 16 is fixed cost, meaning how much is variable cost? If 16 out of these 56,
that's 40,000.
that means 40,000 out of this,
40,000.
right? We know this 40,000 cans out of 40,000 CDs, right? Is what? Variable cost. Okay. But we know that this total cost was for the 80,000 capacity. Now, assuming we want to get total cost for the 100% capacity, what would it be? What would it be? We know that fixed still, right? Fixed cost will still be the 16,000, but variable cost will not be 56. Why? Because if we are getting the 100%, for instance, the 100% becomes a 400,000 tons over what? 0.8, right? End up with 500,000 what?
That's 500.
Now let's get the total cost. Total cost for 500,000 cans. We know that for 400,000 cans, total cost was what? 56,000, right?
56,000.
One match 400,000 cans. Okay. Now we know that fixed cost out of this was what? 60.
16.
Meaning variable cost will be 40, right? Okay. So
Mhm.
you are saying that if variable cost of 40,000 relates to 400,000, and because we know variable cost per unit is always what?
The same.
Variable cost per unit is always what? The same, or it's always constant.
Constant.
Change that constant and use it to multiply the 500,000 cans, and then we get the cost for the 500,000 cans. This is the trick in management accounting that is making people fail. And I can open so many questions. You see that it's there. People do not get that concept. And I want to prove to you that if you haven't made management accounting, it is the same technique that is used in investment appraisal. That's why FM is difficult for you. It's the same technique that is used in strategic case study. That is why it is difficult for you. This thing is across board. Do you understand? If you get this concept, you become a lot smarter. Make sense? I hope it makes sense. So if 40,000 variable cost, because fixed cost, we cannot relate it to this because fixed cost is fixed, right? Unless you want to absorb. And I told you under marginal cost, there's no absorption. So this 40,000 relates to 400,000. So what's our variable cost per can? It becomes what? Taking the 40,000 CDs
That's 10.
over what?
10,000.
The 400,000 cans. So that means we have what? 10 pesos per can.
0.2.
Okay. 10 pesos per can. So since we know this is constant, right? Since we know this is constant, then we know that what? Variable cost for 500,000 cans becomes what? That's the 10 pesos
0.1
times
times
500,000.
500,000.
And that gives us what?
That's 50,000.
That gives us
50,000.
50,000 Ghana cedis, right? Okay. So we have that as 50,000 Ghana cedis. So now that we have that, we know our variable cost. Now we can add our fixed cost, which was fixed, which was what? 16,000. Not so. So that means that total cost at what? At 100% capacity should be 66,000 Ghana cedis. So now we've been able to get a total cost at that level. So you break it down, segregate it, and now you put it in there. So you see that technique we are learning, it doesn't come straightforward. It will be hidden in a question for you to deduce. Does that make sense? This concept, if you get it, I will be happy throughout the whole night because it is this concept that you use it to do almost everything in management accounting. If you can get this for me, have you gotten it? Can we try more illustrations? No, we'll do a better one, but I hope it's clear. So I took a pure decision-making question and I used it to introduce you to it. I hope that makes sense. Is that okay? Did it make sense?
Yes.
Ask
Yes,
questions.
Yes, sir.
All right. Since
But
you-
more examples.
For examples, yeah, I can give you 1,001, but for now, since you've gotten it, let's look at the other costs so that I can put it into a full question for you. Is that okay? All right. So now that we have understood this principle about variable cost, always have it in mind that anything that is variable is constant per unit, right? So you can see it there. All right. So now the next thing I want to look at is fixed cost. We have talked about variable cost. The next thing is what? Fixed cost. So when it comes to fixed cost, how do fixed costs work? Fixed cost, listen, fixed costs here are different from fixed costs that you see in economics, right? Which are usually fixed only during the short term, but in the long term, they become variable. We are not doing economics. ICA or professional accounting assumes the management accountant perspective, and mostly they want to make management accounting simple for you. So they assume linearity of costs. Actually, costs are not linear as you see them. Okay, I don't want to go into advanced stuff, but then basically these are the basics because computer will be doing all these things for you. So fixed costs are simply what? Costs that remain unchanged, okay, irrespective of level of activity, right? In simple terms, irrespective of what? Production, right? Okay. But within a specified range or within a certain range. If you don't add this, I think your answer is wrong. Why? Let me explain. This is my room, right? Where I teach students, right? I rent it. So this, let's say, this is a rented school, right? Where I teach students. Now, this room that I teach students in can take a maximum of 100 students. Are you following? And then I pay rent of 10,000 cedis. Are we okay? So let's look. If I bring one student, how much would I pay? If I bring one student,
100,000.
I'll still pay
10,000.
If I bring 2 students, 10,000. If I bring 80 students, I'll still pay 10,000, right? Rent. If I bring 50 students, I'll still pay 10,000. If I bring 100 students, I'll still pay 10,000. But the room is what? The room is full. True or false?
True.
But if I bring 101 students, that means that extra student, I need another room to fit him in. True or false? And that means that I have exceeded that range that the fixed cost was. So you see now the cost is no longer fixed because it has exceeded that maximum limit of that 100. So you need an extra cost, which calls for an additional fixed cost. Does that make sense now? Are you getting it? So let's put it into a graph. Now let's see this. So this is the rent in Ghana cedi, right? Okay. So I know that I paid what? How much rent did I pay? 10,000 cedis, right? Okay. So if I bring one student, I pay 10,000, not so. If I bring 5 students, I'll pay the same 10,000. If I bring what? 90 students, the same 10,000, right? If I bring 100 students, the same 10,000. So fixed costs look like this. You get it? Because it is fixed. It is straightforward like this. But then what happens if I bring what? 105 students. Now, the landlord will say, oh, this extra room that I'm going for, you see 105, there's 5 extra, right? Meaning they need to go into a separate room. True or false? So the landlord will say, oh, I've been his friend. So for the 2 rooms, instead of 10,000, why not pay 15,000 for the 2? You see the guy has done well. So now my costs have shot up by an extra what? My costs have shot up 5,000, meaning
5,000.
at 15,000 range, right? So this 15,000 now, this student will now be somewhere around here, right? And this one too will go until that room is full. That means when I get to 200 students, the room is full again, right? If I need extra, it will climb up again. So you see it's climbing like a staircase. So fixed costs are fixed up to a certain range. But when you start exceeding that range, you end up with what we call a step cost. And this is the principles that people lack in management accounting, because we assume you have learned it from university because you took the exemption, or you learned it from the lower level. So these things, when they are now brought into question, students fumble because they don't understand them, but they are very easy. You can see for yourself. So when fixed costs are fixed, it's only up to a certain range, you can see. And then once they exceed that range, they become what? A step cost. Does that make sense to everyone? Are we okay with fixed costs? Are we okay?
Yeah. Yes.
All right. Now let's look at something here. Let me give you examples of how step costs work. So for instance, look, I've given you January and I've given you February, right? Giving you January, I've given you February, I've given you March. And then I gave you, let's say, fixed cost of electricity, right? Let me say I gave you electricity and I gave you rent, right? So we know all these things are fixed costs. So let's say that the rent for January, the electricity for January was 500,000 Ghana cedis, right? The one for March was, let me say that the one for March was, okay, they didn't give you one for March, but the units produced, let me bring the units produced on top rather. So units produced. Okay, so this one, 10,000 units was produced. Here, 30,000 units were produced. And here, 60,000 units were produced, right? Okay, so I've given you electricity, 500,000, okay? Rent, this year was 1.2 million Ghana cedis. So these ones are all in Ghana cedis, right? And then I'll give you depreciation, right? Let's add depreciation in Ghana cedi. Depreciation to this year was 240,000. Okay. Then I add what? Direct materials, right? So we know direct materials, variable or fixed. Materials, is it variable or fixed? Materials, is it
Variable.
variable, right? Okay. So materials in Ghana cedis, we have materials for this period being 360,000, right? Okay. Then we have direct labor. Direct labor in Ghana cedi, direct labor was 1.8 million Ghana cedis, right? Okay. Then we have direct expenses. Direct expenses, Ghana cedi. So this one was 620,000. Okay. Then we have variable production overheads. Okay, variable production overheads in Ghana cedis. And this one was in the last month. Okay. The last month, and it was 2.4 million. Okay. So let's say this is what we have. And then additional information. Additional info, right? It says, when level of production or when production exceeds 40,000 units, additional electricity cost of 20,000 cedis is incurred. When production exceeds 50,000 units, now let's say 20,000 units, rent cost increases by 50,000 cedis. 20,000. Let's give you basic examples. Okay. The company has lost its records and has called upon you, okay, and has called upon you to help in the recomputation or reformulation of their operating budget, right? Of the operating budget for the quarter. Management has informed you that the company makes a margin of 35% on all sales. Okay. And non-production costs constitute 30% of fixed costs. Last note or required. reformulate the operating budget of the company, and B, draft the income statement. $20 marks. Say you want a question, and I've given you a question. And my questions are all brainwork questions. So are you writing? You reach where you want me to go down, you tell me. So put the question down. We'll go through this so that you understand cost behavior very well, right? Then, I believe now you all understand fixed cost, you understand variable cost, you understand step fixed cost, right? And I've included all in the question for you. I hope you all understand.
Yes, sir.
Yes, sir.
So let me ask you a question. Distinguish between a fixed cost and a step fixed cost.
Okay. Fixed costs are costs that remain unchanged irrespective of the level of activity, but within a specified range.
Okay, I'll take that.
And step cost comes in when thus you exceed the specified range.
Okay. When what cost exceeds the specified range?
When fixed cost exceeds specified range, it's called step cost.
Sure.
Like the level of activity, right?
Okay. What is the variable cost?
Variable cost changes with level of activity. And then the variable cost per unit is always constant.
Nice. I like that. So what is a semi-variable? The background.
Semi-variable cost is a mixed cost.
Okay. It's a cost that has bits and pieces. Right? It has both fixed and variable components. Is that okay? Are you done with the question?
I think we screenshot it, so maybe you
So,
can continue, otherwise you take.
have you written all these sites? Get some water.
No, sir.
Please, are we all okay? Are we okay now? Are we okay now? Please, can we move? We don't have time, so I think some of these things you have to speed up.
Yes, please.
Yes, sir, we can move on.
Now that we have this, because I don't want to be shifting my screen, I'll do it on the face of the account. Now, let's see something. Which of these costs would you deem as fixed and which one would you deem as variable? That's the first thing you have to do. Because the company has lost this record, so we have to use our knowledge in costing to help them get the budgeted information that they need, right? Okay. So which of them do you deem as fixed and which one do you deem as variable?
Electricity rent, fixed.
Electricity rent and what? Depreciation.
Depreciation.
The assumption in costing is that depreciation is always straight line unless told otherwise. What did I say?
Appreciation is always
It's
straight
always
line told otherwise.
unless otherwise.
Yes, otherwise means depreciation will be variable, right? When they tell you
Yeah.
because reduce
Reducing
balance,
them.
it changes. But straight line is always fixed, the same amount every year. That's the assumption. So now we know that all these costs are fixed costs. It means that they wouldn't change, right? Unless told otherwise. So it means that electricity wouldn't change. It should be the same throughout. But there's a note. And what does it say? It says that what? When electricity cost, when production exceeds 40,000, electricity cost increases by what?
20,000.
This is a step cost.
20,000.
That means this is a step cost. Do you guys understand? So electricity, 10,000 units. Has it exceeded 40,000 units?
Yes, sir.
No, 10,000 units. Has it exceeded 40,000 production?
No.
So we'll not add that 20,000. 30,000 units. Has it exceeded?
No, please.
So still electricity should be same 500,000. Meboa.
Yeah.
Yes, please.
Now when I get to 60,000, has it exceeded 40,000 units?
Yes.
The room is full, right? The room is full. So we need extra room. So extra electricity. And they say we incur additional what? 20,000.
20,000.
Electricity cost should now be 520,000. Meboa.
Yes, sir.
Yes.
How step cost work. You see how easy it is. I hope it makes sense to everyone. Go to rent.
Mhm.
Rent is how much? Rent is 1,002, right? 1.2 million.
Mhm.
But they said when production exceeds 20,000 units, additional rent of 50,000 cedis is incurred. Okay. So since this one is 60,000, it has exceeded that 20,000, right?
Yes.
True or false?
Yeah.
True.
The rent here, they've already added that 50,000 to it already. Do you get the idea? Because it has exceeded. So if you want to get the rent, this one too, has it exceeded 20,000?
Yes.
This one has it exceeded 20,000?
Yes.
Yes. So that means the rent should still be 1,002 as well. Do you understand? Because
Yeah.
once it exceeds 20,000, they would add this 50,000 to it. And since this one has exceeded, it means the 50,000 has been added. But this 10,000, has it exceeded 20,000 units?
No.
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 That 20,000 that is here must be taken out so that we see what the raw figure was. And the raw figure would have been what? 1,100,000 and what?
160,000.
100,000. 150,000, right? Okay, so it means that now if you are working it, what the rent will be this, but when it exceeds 20,000, we must add 50. So if you add 50 to this one, you realize that you have this one. Can you see? And it holds true. So you see how I've included it. If this question should come, I'll tell you almost all the
Sir,
guys.
please, I don't understand. Can you come again?
Read the notes. Do for me first.
You said when production exceeds 20,000, rent cost increases by 50,000.
So
That was thinking it would be 125.
no,
Sorry, 170. 1,250. Yeah.
no. Look at this. The first one we did, there was nothing.
Mhm.
Was there something here? There was nothing here. There was nothing here. And what? Read the first note.
Yeah.
The first note.
When production exceeds 40,000 units, additional electricity cost of 20,000 is incurred.
So let me clean everything. So here was empty. Okay. It's because I've used this. People are confused. Let me change the color for the units and let me change it for the money. So with the let me use blue, right? This one, it was 10,000 units were produced, or let's say 10,000 bags. Let me use bags. This one, 30,000 bags were produced. This one, 60,000 bags were produced, right? Let's say we sell bags. Well, so when production exceeds 40,000 bags, okay, 40,000 bags, additional cost of this. And when production exceeds 20,000 bags, okay, rent cost increases by 50,000. You can see, right? You can see, not so. Okay.
Yes, please.
This one was empty. Let's make this one's empty as well. It was only at the last year. They've lost their records, right? Okay. Now, we learned that fixed costs are what? What did we learn? We learned that fixed costs are
Fixed cost.
Fixed.
They remain unchanged.
unless they get to
Within a specific range.
now it is telling you that that level is 40,000 bags. Immediately you get to 40,000 bags, you must incur additional cost. So check the number of bags. Where do you exceed 40,000?
So 60 March, it was 60,000. Means it exceeded 40,000.
So what becomes our cost then?
We will incur additional 20,000.
But here have we exceeded?
No, please.
So the cost will still be what?
40,000.
No.
Sorry, 500,000.
Now, when we get to 60,000, because it has exceeded the 40,000, we will incur what? Additional 20.
Additional 20,000.
Meaning this now becomes 520. Does that make sense
520.
to everyone?
Yes, please. No.
Here. You see that when we got to the last one, because we have exceeded, we have already, this figure includes the increase. True or false? Does it not include the increase? That means that this figure also includes the increase already. Does it make sense now? Because what if that figure, they will increase it before it becomes this. That means this figure too was increased from some figure before it became this.
Yes, please.
So it means this 1,002, you can't add 50 to it again because it already includes that 50. Is it clear now? So it can't be 1,250 because this figure that we even had here, we increased it from 500 to become 520. It means that this one already has that 50,000 increase inside. Does it make sense to everyone now? Okay. So if you are saying that if you exceed 20,000 bags, you incur additional what? 50,000. 10,000 bags, has it exceeded? It hasn't exceeded. But this one has it exceeded? Yes. Meaning that once you exceed, that is the cost, right? So still, this will become the same 1.2, right? Because it has exceeded and it will be at that same range. But this one hasn't exceeded. So that extra 50,000, which increased because this one has increased from 10 to 30, right? That extra 50,000, it means that it is in here. So we must strip it out. So you end up with what it would have originally been. So it means that when it was 10,000 bags, the cost was 1,150. Then it got to 30, which was more than 20,000 bags. So we increased it by 50,000 to end up with 1.2 million. Is it clear now? Is it clear now?
Yes, please. Yes, please.
Are you sure? Unless you practice again. I know it's the first time. These things, you do them at the lower level, but practice them again. Practice this same question over and over again till you understand the costing principles like a second nature. Though we are doing cost behavior, this is what we call a flexible budget. Okay? We have what we call a flexed budget. We have what we call a flexible budget. A flexible budget is a budget that is reflected at different levels of activity. And a flexed budget is a budget which is adjusted to reflect actual levels of activity. So some people say they are the same, but it's a lie. Flexed and flexible budgets are different, though they use the same principle to deal with them. And flex and flexible budgets are all about cost behavior. That's why I tell you, cost behavior is king in management accounting. You understand it, you understand management accounting. Is that okay? So that's how step cost can be inculcated into any question. If you ask questions 1,000 times, I will help you understand 1,000 times, because if you don't get the basics, I will not be satisfied. It is this that will make you a guru in management accounting. So feel free to always ask questions. I'll be there to help you each step of the way. Yes, please. Any question or still it's not clear? Can we go again? Or we can.
Sir, please can you explain the rent again? How we got the 1150?
Okay. Let's see. This is Kofi, right? You are saying that, look, if Kofi gets 10 marks, look, if Kofi gets 10 marks in the exam, you are going to give Kofi an apple. Look, oh, if Kofi gets 30 marks, you are going to add, if Kofi gets more than 20 marks, look, if Kofi gets more than 20 marks, you are going to add juice to the apple. Look, you are going to add juice to the apple, right? Meaning he will have apple and juice. True or false?
True.
Now, in the information we had 10 marks, meaning Kofi will have what? Is it not apple?
Yes, please.
We had 30 marks. Has it exceeded 20 marks?
Yes.
So Kofi will have apple and what?
Juice.
And then we had 60 marks. Kofi will have what? Kofi will have what?
The apple and juice.
Kofi will still have apple and juice because he has exceeded 20. Okay, nice.
20.
So now we want to get only this. At 10 marks, what is Kofi expecting?
Apple.
Only apple. But what we have
Yeah.
is apple and juice. So we have to take what? The apple and juice and deduct what? The increase, which is the juice from it. So that we are only left with apple only.
Yes, yes.
So you are saying that, yes, when production exceeds 20,000 bags, which is Kofi now, when Kofi gets more than 20,000 bags, you will dash him 50,000. And now Kofi has got 60,000 bags. Has he exceeded?
Yes.
Yes.
1.2. Does it not include his 50 already?
It does.
So we want to get what Kofi would have had if he didn't satisfy this condition. That means he wouldn't have gotten the 50, right? So take out the 50 from what you already have to get what the original would have been, only the apple without the juice. This is the juice. So you're taking out the juice from the apple and juice to only arrive at apple. So now here is apple and juice, here is apple and juice because he exceeded the condition. Does that make sense now?
Yes, please.
So me, I'm adding my own scenario. So let's say January was 10 and let's say February was 20. That one, it means he has also not exceeded. So it would still be apple.
Yes, it will still be only apple. Thank you.
Okay.
He exceeds the extra cost to be added, meaning he has exceeded the range. I hope that makes sense. Please, are we okay with the rent cost now? Hello. Hello, my beautiful people. Are you okay now?
Yes, sir.
Yes, sir.
Sir, please, let's move on to the other footnote.
Which other one? Is that we should move on to which other one?
The other footnote.
The other?
Footnote.
Okay. Yes, that's where we are moving. I just wanted this to be. Okay, now depreciation. They didn't give any note on depreciation, right? And we know depreciation is fixed. That means since there's no footnote, it means depreciation will still be what? 240, 240, 240. Meboa. Aha. You see, because depreciation had no note, no step cost, it means no matter the range, depreciation will still be the same. Did you guys get it?
Yes, please.
Okay. Now let's come. They are direct materials. Direct material, what is it? Is it variable or fixed in nature?
Variable.
Variable. And then we know that what? Variable cost per unit is always what?
Constant.
It's always constant. So since it's always constant, it doesn't matter the level of activity. We can just find the per unit and multiply by the number of bags to get the missing figure. Does that make sense? So that means direct material per unit becomes what? You see, it's easy. Direct material cost per unit is what? which level were we giving? We were giving 360,000, but the level of bags produced was 30,000. So can we get a per unit? So it doesn't matter where it is. So this one, the cost was what? 360,000, right? But the number of bags was 30,000 what? Bags. So since this is constant, it doesn't matter where it is. We can find it and use it to multiply the total. Does that make sense? So 360,000.
Yes, so that's 12.
That means that direct material cost should be 12 per unit. And since the cost of one bag will be the same, irrespective of the number of bags we produce, we can multiply by the number of bags here, saying that, okay, since direct material is now 12 cedis per unit, 12 cedis by the 10,000 bags will easily give us what? The cost
120.
That means this one should have been 120,000 cedis. And by the 60,000 bags,
720,000.
720,000. You see how easy this is? So we are filling their records because they have incomplete records. We are now filling it up. We can do the same for labor, right? Labor is also variable. So direct labor per unit is going to give us what? We had labor at 1.8 million, right? And we know variable cost per unit is constant.
And that's 30.
How many bags were produced?
60,000.
1.8 belongs to 60,000 bags, right? So we divide this by 60,000 bags.
Yeah.
Then that means that the cost would have been what for labor?
30.
30.
So 30 cedis per unit is labor. So now that we know it's 30 cedis per unit, since labor is 30, 30 is constant per unit, right? Irrespective of how many bags we produce. So we can fill it in. 30 by 10,000 bags, that's what? That means labor would have been 300,000 also. And 30 by 30,000 bags, that would have been what? 900,000 bags. No,
100,000.
okay. The same for direct expenses, right? So direct expenses. You see how costing is interesting when you understand.
Yeah.
But before it looked alien to you, it is like
Yes, so.
Okay, so let's put so direct expenses per unit. We were given at the 10,000 level, right? So this was for 10,000. So 620,000. How many bags were produced at that level? 10,000 bags, right?
10,000. Yeah. So that would be 62.
So that would be 62 cedis per unit, right? Now that we know this is 62 cedis per unit, can we get the missing figures? Yes, we can. So this was 62 cedis. Since it's 62 cedis, we have 620,000 divided by what? 10,000 bags, giving us the 60. So
10,000.
By what? 30,000 bags. We get what? 1,860,000. Then by the 60,000 bags, this is by 2, right? That is 3,000,000.
3,720,000.
Not so. Okay. So variable production overhead, we can do the same thing, right?
Yes, sir.
Variable overhead, because it's variable, also constant, not so. So 2.4 million divided by what? How many?
60,000.
What's at 60,000 level, right?
Yeah.
Level, and that gives us what?
And that's 40,000.
You said that gives us a
40 per unit.
40 cedis per unit. Okay, so now that we know this is 40 cedis per unit, we can fill it in, right? And get the total cost or the total budgeted cost. Okay, so let's see.
So the first one is 400,000.
400,000. So 40 by this, 400,000 cedis. And the next one.
That's 1,200.
1.2 million. Okay. Okay, so we have filled it in, right? Now we are only, because of time, we are only going to prepare income statement for only March. Okay, so just add up March. The rest, I know you understand. That's the budget. Let's do only March. So March, the total cost will be what? 1.2 million. 520,000, right? Plus 1.
Plus 1.2.
Plus what? 240,000, right?
240.
Now,
Plus
I wouldn't add the direct because I know all these things are fixed costs, right? So I would sum this up so that I don't go and do another work again. So sometimes you have to open your mind. Otherwise, if you add everything, you need to apportion the fixed costs. You are now coming to add again. So here I'll add all and call them what? Fixed costs, right?
Fixed costs.
I add all this fixed cost, what do I get? I have
1960.
plus 1, 2, plus 240.
1960.
You said it's 19.
60.
Yes, 1,960,000, right? Okay.
Yes,
And
please.
fixed. Okay. So if I add all this, right? If I add all this, what do I get for the variable costs? That's 720,000 plus
Yeah,
one,
that's
8640.
8640.
Million.
plus 2.
8640.
8640. Which one is 86?
Yes, please. The total variable cost.
The total of variable cost.
Mm.
You said it's
640 million.
8640,000.
Yes, sir.
Like this. Okay, so this is a variable, and then we can get our total cost, right? Okay. Now there's a reason why I did this. To add the variable cost to the fixed cost. 8640.
10,600,000.
That's 10,600,000, right? Okay. The budgeted cost for March. Okay, now we've gotten our total cost. So I'm going to prepare the account based on the what we call marginal costing and absorption costing, just to show you how it works before we dive there, right? So the question was involving but you see when you understand it, it's straightforward. Okay, so first of all, let's get our non-production cost. They said non-production cost was what percentage of fixed cost?
That's 35.
35%. Oh.
30%.
30% of fixed cost. So non-production cost will be 30% of the fixed cost that we calculated. That's why I said we should be careful. So next time. So
30%.
1960 times 30%, right? So 1960 by the 30% will give us what?
588. 588,000.
588. So we've gotten this. That means this is non-production fixed cost. That means production fixed cost will be how much? That means that one will constitute 70%. Not so.
Yes, sir.
Total.
Yes, sir.
This one is non-production. It means that the 70%.
1/3.
That is how much?
Yeah, 1,372. 1,372,000.
So that's
1,372,000.
So now we have the information that we need, right? So I'm going to prepare the income statement based on the information that we have, okay? But then, first of all, we have something we don't have. We don't have the selling price, right? And then we know that they make a margin. So determination of selling price, I don't want it to be helter-skelter. Let me separate this working. So let's come here. We know that selling price, I taught you how to do all that using markup and margin, right? Since they say margin, we put down cost plus profit equals selling price, right? And we know that margin is 100. Sales is equivalent to 100%. Sales is 100. And they say you make a profit of 35. It means cost would have been equivalent to what percentage? Box plus 35 should give us 100. What is box? 65.
I don't know box.
That means box is 65, right? You know, that means the cost is the balancing figure. And already we know that total cost was 10,600,000. True or false? We are saying that if 65% is equivalent to what? 10,600,000, then the sale, which is equivalent to 100%, will be what? It will be more. If more, let's divide, right?
Let's divide.
This is like, we know the 65% already, but we don't know the 100%. And I told you that anytime you have a percentage and we want to find the 100, what do? You just divide by 0. That's all. So you can just take this 10,600,000 and just divide by what? 0.65 to get the 100%. Or simply say 100 out of 65 times 10,600,000, right? And then we end up with the selling price or the sales for March. 100 out of 65 times 10, 600,000. That means our selling price becomes what? 16 million 307 690. Oh, so now we've gotten selling price. We have all the necessary costs, right? So now we are going to look at the distinction between absorption costing and marginal costing. For absorption costing, it prepares profit like the way you do in accounting, right? So under absorption costing, it means that profit is determined this way. We get our sales, right? Then we take out our cost of sales, okay? Which is what? Our production cost. You guys understand, right? Then we get what? Gross profit. Is that not what you learned in school? Then now you come and take our selling, admin, and distribution costs, right? Which we know these are non-production costs, right? Then you arrive at what? Net profit. Is that not what we learned in financial accounting class? Is that not what we learned in financial accounting class? Sales minus cost of sales. You get gross profit.
Yes, sir. Yes, sir.
Then you come and deduct other costs, operating expenses, then you get net profit. This is what we call absorption costing. Is that okay? And this cost of sales, we know is what? Opening stock, add purchases or production costs, right? Minus closing stock. True or false? Then you get gross profit. That is it. Now, for marginal costing, marginal costing takes a different tune, okay? Because this one focuses on cost. What is the classification of cost here? Is it by function or by behavior? This one.
By behavior.
No, absorption costing. How do we classify cost? Is it by behavior? By function, because here we group cost production and non-production. You get it? So this one categorizes cost by function, and this one categorizes cost by behavior. That's the only get it. So under marginal costing, we determine profit this way. We take our sales and we less all variable costs, right? So our cost of sales is our variable cost of sales. Then we now come and get the most important profit in management accounting. We use it to take all our decisions. So sales minus all variable cost is called contribution. Then now we deduct all fixed costs, right? So I told you here we don't absorb. So all fixed costs are period costs. Okay. So this is the only difference between marginal costing and absorption costing, apart from the stock valuation and all that, right? So if you are preparing accounts, if it's absorption costing, that means that we do sales, less production costs, gets gross profit, take out non-production costs to get net profit. But absorption marginal costing, we deduct sales minus what? All variable costs, get contribution, then we take out all fixed costs. That means that if you have a cost which has variable and fixed together, you have to split them. Otherwise, it won't work. True or false? True or false?
Yes.
Yes, because we need variable cost separate, fixed cost separate. So if they are together, we need to split them. And contribution is the most important profit used to take decisions. What did I say?
Contribution is the most important profit used to take decisions.
Yeah, so in management accounting, your whole life in management accounting is about your friend contribution. That is the story. The whole management accounting course, it's about your friend contribution, right? So that's the things that should be in your mind. If you are here, you don't know contribution, you don't know variable costs and fixed costs and how to split them, then don't set the paper, because everything around management accounting is literally centered around contribution. Everything around management accounting is centered around
contribution.
Contribution. So if you're a student who understands contribution, you understand what variable costs and fixed costs are. Your life will be easy. So let's know. If I sell 1 unit for 10 cedis, okay? If I sell 1 unit for 10 cedis, if I sell 2 units, won't I incur cost? Won't I earn 20 cedis? If I sell 3 units, won't I incur 60 cedis? I said 30 cedis. Do you all agree with me that selling price per unit is also constant per unit?
Yes.
The more you sell, the more.
Okay.
The more we sell, the more we earn. True or false? Variable cost, the more produce, the more we incur. So it means that if sales is constant per unit, true or false? Is sales not constant per unit? Selling price. Is selling price constant per unit? Is selling price variable in nature? Is selling price
Yes, sir.
variable in nature?
Yes, sir. It's variable.
It's variable because you sell more.
Yes, sir. Get more.
Yeah.
Variable costs are also constant per unit. True or false?
True.
Does it mean contribution per unit is also constant? Answer me. Yes or no?
No.
Yes, since it takes into consideration only variable cost.
Selling price is constant per unit minus variable
Mhm.
cost, which is also constant per unit.
Oh, yeah, it's constant.
So is contribution per unit constant?
Yes, please.
Yes, sir.
You are an Englishman. Your wife is an English woman. Would you give birth to an English child?
Yes, please.
Why are you saying no?
You said yes.
Somebody said no first.
Mhm.
Selling price per unit is constant. Variable cost per unit. It means that their child, which is contribution per unit, should also be constant. I'm giving you this to save you a lot of work in management accounting. Instead of going to calculate sales separately, marginal cost or variable cost separately, you can just straightforward get the contribution per unit and use it to work your question. And then you finish quick, and get the same marks. I will use 4 lines. Look at this. We'll get there. I'll use 4 lines to make 10 marks. And another student will use more than 40 lines of the same question to get the same 10 marks. Which one would you prefer? Which one would you prefer? 4 or 40? The same marks. Which one would you prefer?
So the first one.
The first one, yes. How come some of the methodologies we'll use will be very simple? Okay, because you have to get that mindset, that management accounting mindset. It's not about just learning it. No, you need tricks. Do you understand? All right. So now I believe you understand. I hope you wrote these equations down because this is it. This is the whole thing. It is now that we are now going to break them down. This is it, the profit statement. Did you write them down? Don't just take a shot. This one, I want you to put it down. Absorption costing. We determine profit this way. Sales minus you get gross profit. Take out your non-production cost. You get net profit. Marginal costing, sales minus all variable costs. You get contribution. You take out your fixed cost. You get your net profit. Is that okay? And remember our good friend contribution, because from today, we'll be using contribution anyhow. Okay, don't forget this. Have you put it down? So we are now going into the question based on what we had, because now we have the selling price or the sales, and we can use it to get what? Our profit. Can we go? Can we go now? Can we go now?
Yes, sir.
Okay, so I'm going to split the screen here. And then this will be my income statement, right? This will be my income statement under absorption costing. So here I'll prepare my income statement based on absorption costing. And here I'll prepare my income statement based on marginal costing. Okay. So let's start with this one. Already I have my sales, so I can go up to go and take my sales. Sales, we had 16 something, right? We can even do it here again. I don't want to go up. So we can do what? 100 out of what? 65 times 10,600,000 also. If you do it again, what do you get? You already know our sales. Was 160,307,692. Also. Then now we are going to less what? Our cost of sales, or simply our cost of production, because we are producing to sell, which is still our cost of sales. Also, because we only produce to sell. So the question is, did we have any opening stock? We didn't have any opening stock, right? Opening stock was nil. The question had no stock, right? But cost of production. Cost of production. What and what did we have for cost of production? You can just go and pick the total variable cost that we had, or we can pick them direct material, direct labor, direct expenses. We can pick them that way too. So give me the details. Direct material was how much? Direct materials, yes. Let's pick from the question. Direct materials, 720,000, right? I believe this one, but you should have written it. Direct material was 720,000.
Okay.
Direct labor was how much? I believe it was 1.8 million. Yeah. We're only doing for March. This was 3,720. Direct expenses. That's 3,720,000. Then we have variable production overhead. That was 2.4 million, right? So we are gathering all the production costs. Then we have what? Fixed production overhead. You remember we had fixed production overhead. That was 70% of the total cost, the total fixed cost, right? Which was 1,960,000. Do you guys remember? So we need fixed production. So we are looking at all the cost of production. So that is what, 0.7 times the 1,960,000. And you guys had it to be what? 1,372,000. So now you are saying that these figures that you have, right? There's no closing stock, but this figure would have been what? This is like the cost of goods available for sale, right? So cost of goods available. You guys know that, right? This is the cost of goods available because this is opening stock. Then you add what you produce during the year. So this is what is available for sale. Does that make sense? Does that make sense? Hello?
Yes, sir.
Because we already had opening stock, then we produce more for the year. So that gives us what is available for sale. So we end up with 10,012,000, right? Then we now take out what? Our closing stock, right? But did we have any closing stock in the question? No, right? So it means that our cost of sales is still 10,012,000. Okay. So now we deduct it from the sale, and then we end up with our gross what? Our gross profit. So gross profit will now be what? 16,307,692 minus 10,012,000. And that gives us 629,692 as gross profit. Then now we are going to less non-production costs from this. And non-production costs, since the total fixed cost of rent, electricity, and depreciation has been split 70% for production fixed cost, the rest of the 30%, they said is for what? Non-production costs, do you remember? So that 1,960,000, 30% of it is non-production in nature, which is 30% of 1,960. We calculated it before as 588,000, right? So we deduct our 588,000 from this, and then we end up with what? Our net profit. End up with our net profit. So in that case, we take our 6,295,692 minus our 588,000. And that gives us our 570,692 as the net profit according to absorption costing. It doesn't mean it has to be, you could have just added the cost of production separately, then you just bring it opening stock plus the cost of production, which is the balancing figure, minus your closing stock, get gross profit, take out what? Selling, distribution, and admin expenses. Okay. Now, the marginal costing, the same thing will be done. Will result in the same profit because we didn't have stock, right? The only difference between them is that we value stock differently. So here, sales will still be the same, 16,307,692. Then we are going to test our variable costs. All variable costs, both production and non-production, right? So variable cost, the same way, opening stock. Opening stock. Stock is variable. We didn't have any opening stock, but we had production cost, right? So production cost, all we can do is just what? Add everything up. So the same way, our production cost will still be the same, right? So direct material, still the same. So direct material is variable. We know that 720,000. Direct labor, also variable, 1.8 million. Direct expenses, also variable. That's 720,000. We have variable production overheads, still variable, 2.4 million. Now fixed costs are fixed. Here only variable costs, so that fixed cost will not be added. So here we add everything up. That gives us 720,000 plus 1.8 million plus 720,000 plus 2.4 million. And that gives us 8,640,000. Okay, and that's our total variable costs of production. Okay, that is it. Then closing stock. We didn't have any closing stock, right? So it's still the same cost of sale, 8,640,000. We deduct it. Then we now come and get what? Sales minus variable cost will give us what? Sales minus variable cost will give us what?
Contribution.
So this is the total contribution, right? But you see under absorption cost, instead of contribution, we add gross profit. That's the only difference. So we have what? 16,307,692 minus our figure. We end up with what? 7,667,000. Let me rewrite this one. 7,667,692. So now that we have contribution, we have to take out fixed costs, right? So we now less our fixed costs and then fixed costs. We had two types of fixed costs in the question. What were they? Production fixed costs, right? So production fixed cost, which we know we had it there as 70% of what? The 1,960,000. I know it's already there, but I'm just reminding you. So we get 1,372,000, right? So here you are just lessing all fixed costs. There's no need to categorize them. So I could have equally just less 1,9,250, but I just wanted. Then we have the non-production fixed cost, right? Which is selling, admin, and the rest. And that one too was what? 30%. Do you guys remember? 30% of the 1,960, which gave me what? 588, right? 588,000. So it means that overall, I'm just lessing the whole 19. The 19, it was 19 what? 1,960,000, right? Out of the total contribution. Okay, and that one gives me my net profit. And because there was no opening and closing stock, you will realize that the net profit will be the same. So you see, you get 5,707,692. Is it not the same? So the profit will be the same when there's no opening and closing stock. I intentionally converted the question we are solving into margin and absorption costing. So if people are getting scared, don't be scared. Rewatch the video over and over again until you get this. If you get this, trust me, that is the end of management accounting for you. Everything will go so smooth. This is the learning curve, right? The whole thing is that this thing, we assume you should have done it at the lowest level of costing, but most of you didn't do it. So when it comes here, you just rush through. I don't believe in that. Get it. Solve it over and over again till you get the principle. I believe in that. If you can do that for me, trust me. I told you I'm there to assist you throughout your journey to make sure that your journey is a successful one. But I realize sometimes we rush through things. Take your time, ask questions. Don't be disappointed. Go through again. You'll be fine. Is that okay? So the conclusion is that so far as there's no opening and closing stock, right? Both profits will give us the same. We'll get what? Yeah, this is the solution for only match. I wanted us to do it for only match. That is why I just gave for only one month. And this question is complex. I made it like that. But in exam, nobody will give you something like what I'm giving you. This one, I'm just giving you the concept, right? But I hope it's clear. The format is still the same, right? Sales, less cost of sales, get gross profit, get non-production cost, get net profit. This is what you do in financial reporting. Here you do sales, less all variable cost, get contribution, take out all fixed costs, get net profit. Is that okay? Hello?
Hi.
Everybody okay?
Yes, sir.
All right. So now we are going to solve proper margin and absorption costing questions, but let's look at some differences between the two methods, right? And the differences are mostly on the treatment of fixed cost, right? So treatment of fixed costs, okay? And inventory values. Okay, so these are the only differences that the two methods offer. And then another thing I want to talk about is that if absorption costing, if closing stock, this is what I used to always remember. If closing stock is more than opening stock, right? If closing stock is more than opening stock, then absorption costing profits will be greater than what? Marginal costing profit. I don't want to write the other side. Definitely, you know the other side will be the reverse. So that means if closing stock is more than opening stock, then absorption costing profit will be more than marginal costing profit. Okay. So that means if opening stock is more than closing stock, what happens?
It will be less.
It's more than closing stock. What will happen? That means what?
Absorption cost will be less than marginal cost.
Marginal costing profit will be more than absorption costing profit, right? So have this with you, okay? So mostly the difference, okay, the difference in the profits, okay, is usually because of what? The difference in the closing stock or the difference in the stock, right? Because you are going to learn how to value stock. So the difference in the profit is the difference in the stock. Do you get it? Meaning that if I take the stock, marginal costing stock minus absorption costing stock, I am going to get the difference. Or I can just take the overhead absorption rate, I'll calculate times the difference in stock. Difference in stock units. I'll get the same thing. Okay, don't worry, when we solve a question to make sense. Then another thing I want to do is that when it comes to valuation of stock, I'm just summarizing the whole thing so that you don't read plenty. When it comes to valuation of stock, right? Absorption costing, we use full production cost per unit. What did I say? We use full production cost what? Per unit. It means that we include fixed cost. It means that here we value cost using the all variable cost per unit plus fixed cost per unit. And we know fixed cost per unit is OAR, right? Mostly you have to absorb. But marginal costing, no absorption, right? So marginal costing, we only value stock using the variable cost of production per unit, right? Variable cost of production or variable production costs per unit, right? So remember this. So here is only variable cost per unit that we have, because under marginal costing, there's nothing like absorption for fixed costs. So fixed costs do not exist per unit, right? So we only have variable cost per unit, no fixed costs. Fixed costs are only treated as period cost. Remember, I told you the marginal cost is no absorption. So when you do marginal costing and you see fixed costs, if they are not in total, you ignore them. They are irrelevant. Is that okay? So when you are valuing stock and the absorption costing, we use full production. Marginal costing, we use only the variable cost. The treatment is the differences. The treatment is in the fixed cost of the inventory. And you can see why. Because the inventory, this one we add fixed cost. This one, no fixed cost. So definitely to change the profit. True or false? True, of course, because one will be higher because one has fixed cost and one does not have fixed cost, so it will be lower. That is the whole rule. Write these things down. Let's take a full question, and then you start to appreciate marginal and absorption costing. If you write it down, I'll teach you a new concept. I know some people will be fumbling. That means that exemption now, OJ, and wins, you see you. If you are done, you tell me.
Yes, you are done.
All right. So there's one thing I want to introduce you to before we start taking full questions, and that is the concept of under or over absorption. Now, this under or over absorption is actually what we call the fixed overhead expenditure variance. Okay, so if you go to exam and they ask you to calculate the fixed overhead expenditure variance, they're actually asking you for under or over absorption of overheads. Now, what does this mean? Let me ask you something. Assuming you are saving to go and purchase an iPhone for 13,000 Ghana cedis, right? Please, are you all listening? You are saving to go and buy an iPhone for 13,000 Ghana cedis. Now you get to the iPhone shop and the current price of the iPhone is currently 15,000. My question is, have you undersaved or you have oversaved?
Undersaved.
Saved.
Undersaved, right? You have undersaved by how much?
2,000.
So if I want to now actually, if I want to actually pay for the iPhone, that means I must incur an extra expense. True or false?
True.
So this under saving is an extra expense to the company. True or false? Okay. This scenario one. I hope it makes sense to everyone. Now let's go to.
Yes, please.
I was saving 13,000 for that iPhone. Oh, right. I was saving how much? 13,000 for the iPhone, right? I got to the shop and then the price, the actual price of the iPhone was now worth 10,000 Ghana cedis. Have I under Susu or I over Susu?
Oversusu.
Oversaved, right? So that means I must what? Give back the company how much? An extra 3,000, right? So this one is not an extra income to the company. Is it not an extra income to the company?
It is an extra 3,000.
An extra 3,000. So it tells us that anytime you undersave, it's an expense, right? Anytime you oversave, it's an income. Do you understand? And this only works under absorption costing because we can only under absorb or over absorb. Does it make sense? So we are saying that to get under or over absorption, are you listening? To get under or over absorption can either be an income or an expense. But how do we get this? All we are comparing is that we estimated some overheads, right? So we compare our overhead absorbed. So we compare our overhead absorbed against our actual overheads, right? Our actual overheads. Okay. So just make it the fixed overhead variance. So it depends. If it's marginal cost, and then it becomes only the fixed overhead. It only becomes the fixed overhead expenditure variance, but this is the fixed overhead variance, right? And the absorption costing. Okay, so overhead absorbed compared to your actual overheads. And how do we get overhead absorbed? We are just taking our fixed overhead per unit, right? Which is our OAR. We know that OAR is our fixed overhead per unit, right? Because fixed costs only become per unit when we calculate OAR. Whether under absorption costing or activity-based costing, we get our OAR and now multiply by the actual level of activity, okay? Now we compare this to the actual overheads, and the difference is the under or over absorption, okay? The under over absorption can be either what? An income or expense, as I taught you, right? So we'll take some simple illustration to understand what I mean. So let's say that I have budgeted information here. So at this juncture, I know diminishing returns have started setting in. Don't worry, rewatch the video again once it is shared. Is that okay? Practice. That's why you have a whole week until Sunday. So today, this is all we will do. Sunday, I'll now introduce you to other concepts. Then we solve a detailed question because these concepts are very important. That is why most of the time it is skipped in class because we assume you've done it. So you are not going to waste our time to teach you again. So this is a question, right? So I've given you budgeted information. So let's say that the company had budgeted fixed overhead, right? Budgeted fixed overhead, okay, of 500,000. Okay, this is what it has. Then it produces two products. Produces two products. Product A, okay, where it is expected to produce 10,000. Write it down. This is a full question. 10,000 units. Product B, it is expected to produce 20,000 units for product B. Okay. So let's see the labor hours per unit. Product A, budgeted labor hours per unit is 2 hours. Product B, budgeted labor hours per unit is 4 hours, right? This is what we have. This is the information that we have for this one, okay? Then let's go to actual information. Actual information. Product A, okay? We used 40,000 labor hours, okay, 40,000 labor hours, and incurred a cost of 280,000 cedis. Then for product B, we used 90,000 labor hours, which resulted in a cost of 480,000 cedis. So this is what we have. Okay, if we add this to the actual overheads, the actual overheads is 280,000 plus
760.
That's 760, right? Okay. This is what we have. And then it's telling us to required overhead absorption rates. Don't mind me, my questions are usually very difficult too. So if you see it like that, you think that is it, but my questions are very handicapped questions. Then under or over absorption. All right, so my mind is twisted. So all my questions are twisted. All right, so we have a company. So you just start and say a company has the following information. I should have even given only one product, right? So that it makes everything easier for you guys. Or what do you think?
Oh, say, please, it's fine.
Okay. To do it, let me search for my question bank and see if I can get a lot of questions around this. Till we get it, we are not moving forward. Because I believe some of your costing, today, Namingu says some of you, your costing background, we need to work on it a little, right? Otherwise, you struggle. I'm telling you the facts. Is that okay? Have you put down the question? Right. Right.
We have.
Okay. I hope
Say it's not easy.
Some of us are not accounting students,
don't
so.
worry about it. That's why I'm here. That's why I'm here for you.
Madam,
I'm teaching.
the accounting students, some are not seeing
Get
top.
it. Accounting students, guys, they will not get it. So don't worry. Small. We'll get there, right? I'm just introducing you to it. We'll do it step by step. So first, I show you the general picture. Then from there, we take it one step at a time. Is that okay? So now with the information that we've gotten, OAR, I believe everyone can calculate OAR, can't we? Can't we? We all learned how to calculate the overhead.
Yes, we can.
Right?
Yeah, we can. The total budgeted.
So
Over.
OAR.
Budgeted fixed. Divided over the total.
So OAR gives us what? Our total what? Budgeted what? Overheads, right? Over what? Our total budgeted what?
Activity
But
or absorption basis.
Labor hours, right? Because here it's only labor hours we had. True or false? So
True.
Our total labor hours. I think the yellow is too hard on the eyes. Sorry. Let me use a different color. Okay, so total labor hours, what do we get? I believe we had two products, right?
30,000
Product
units.
A. Product A. We use
Product A.
We use 2 hours, not
2 hours, yeah.
But how many units were we producing? Because I believe the whole 500,000 that we were giving was for all the products. Do you understand? So 2 hours, we are producing 10,000 units. So 2 hours units. That gives us what?
20,000.
We use 20,000 what? Hours. Are you getting it? For product A. For product B,
4 hours.
4 hours, but we are producing 20,000, right? So 4 hours per unit times 20,000 units. And that gives us what? 80,000 what?
80,000 hours.
Our total labor hours, total budgeted what?
Overhead.
Hours gives 100,000.
100,000 overhead.
So now we've gotten that. Now we can get our OAR, not so. So our overhead absorption rate now gives us what? Our total budgeted overhead, which was 500,000 per the budget information, not so. And our total budgeted labor hours, which were what? 100,000 labor hours, not so. Okay, so now when we divide, it means we get what? 5 cedis per labor hour, not so. True or false? Is it not 5 CD per labor hour?
Yes, please.
Okay, but we must multiply. How do we get our under-over absorption? I gave you the formula. I said under-over absorption is giving us what?
That's the overhead absorbed minus actual overheads.
Okay, we compare, right? So overhead
Yes, sir.
overhead absorbed compared to our actual what? Overhead, right? And our actual overhead, how much actual overhead cost did we incur?
That's 760,000.
We incurred a total of 760,000, right? Okay. But overhead absorbed is simply our OAR times our actual level of activity, right? Which is our actual hours. Okay. So we are saying that if we take product A, our OAR was 5 CD per labor hour. Mebwa. No, so. But how many
Yes, sir.
were actually used? How many hours were actually used for product A?
40,000.
40,000 hours, right? Okay. And how many hours were actually used for product B?
90,000.
90,000 hours. Not so. Okay. So overall, we know that this one was 5 per hour times the 40,000, giving us what? 200,000 also.
200,000, yeah. And then 450,000.
450,000, right? So overall, we are saying that we have what? 650,000 expected to be absorbed, but we actually, so we went to iPhone shop, we are expecting, we saved 650, but when we went, it actually cost 750. Are we under Susu or over Susu? Have we under
Over.
We estimate
under.
we estimated to spend 650, but we actually spent 760. Have we
Yeah,
under,
so we under.
we are under Susu, right? Underestimated by how much? 110,000, right?
Yes, sir.
Under absorption, meaning this is an extra what? Expense.